Well, good morning, afternoon throughout the Federal Home Loan Bank of Des Moines District, and welcome to our webinar on the Public Unit Deposit Letter of Credit Opportunity. We're running the webinar today out of Seattle, the Western office, and if you can believe it, there is snow on the ground. The good news is there's 100-mile visibility today, but we're not blinking. I'm John Biestman with the FHLB Des Moines, and together with my colleagues on the Member Strategies team, we both work with our member financial institutions on developing balance sheet strategies. Today, we'd like to review and demonstrate the impact that the methods of collateralization of public unit deposits can impact liquidity, income, and efficiency metrics of our member financial institutions. Before we begin, a few operational matters. All registrants will shortly be sent a link to the webinar presentation when we're through, so you will receive the slide deck. The webinar also has a chat feature. On your sidebar, feel free to type in a question as we go along. And finally, we'll have several questions throughout the presentation, and we're going to poll the viewing audience. There are going to be 4 specific polling questions, so we'll try to make this a wee bit interactive. Please cast your responses on the side panels, and we'll be measuring your thoughts as we go along. And lastly, if you have any issues hearing us, please use the chat feature and do let us know about it. Okay, today we're going to talk about the most widespread purpose of the FHLB Des Moines Letter of Credit issuance, that being standby letters of credit that are issued in favor of public units. Those state and local municipalities and school districts that typically deposit funds in with our member institutions. Most of the time it's banks, but also in some states such as Minnesota and Oregon, credit unions are getting into the game as well. I'll be covering a number of aspects on standby letters of credit and public unit deposits as we go along. And we'll start with an overview of the PUD market and collateralization options that are typically available. We'll also focus on using the letter of credit as a collateralization method compared to such other methods as pledging securities, surety bonds, and even more methods. So finally, I'll demonstrate some typical balance sheet situations that we see our members running into, including an evaluation of the relative impact on liquidity and income involving collateralization of public unit deposits with letters of credit versus the act of pledging securities. So we're hopeful that some of the observations now will prompt some discussions on your balance sheet management strategies as you move forward. I'm guessing that many member institutions of the FHLB Des Moines on the webinar currently access funding via NOW, MMDA, or time deposits from municipalities or subdivisions. You might be attracting these deposits from school districts, bridge and port authorities, or sanitation, utility, and fire districts, or pooled state funds. The list really goes on. Deposit volumes from public units often vary in magnitude, as we know, and they fluctuate with seasonal revenue collections, such as property or income tax dates, and even collection of bond proceeds. So the balances fluctuate, as we know. Public unit depositors are typically heavily focused on credit worthiness, safety and soundness of the depository. It often seems that rates of return are viewed as a secondary consideration. It's about safety. And as a result, public units are frequently bound by statutes and or their own investment policies that require collateralization of deposits in excess of FDIC and NCUA limits of $250,000. So per some 2013 FDIC regulatory language, as an example, on deposit insurance coverage, they say, and I quote, "Collateralization provides an avenue of recovery in the unlikely event of the failure of an insured institution. So what we're going to do here, we're going to get interactive. And before starting with a discussion of public unit deposit letter of credit mechanics and applications, we're going to start with a trivia question to ask the audience. And it goes like this. How widespread do you think public unit deposit funding is amongst the FHLB Des Moines membership? And the way that we're going to phrase the question is, of non-credit union members of the FHLB Des Moines, what percentage would you guess of them were using public unit deposits as a portion of their funding base? These funds, of course, could be either in the form of transactional demand or other forms of deposits. Why, you ask, do we exclude credit unions? Because, again, they are only permitted to take on public unit deposits in certain states within the district, including Oregon and Minnesota. Winners of the poll here are going to get complimentary passes to our upcoming regional member meetings in one of 16 locations throughout April and May. I'm just kidding. Everybody gets in for free that's a member. You should be hearing about these from your region, your representative managers, your RMs. So we're going to go over to Scott Hofer. Scott is with us in Member Strategies. He's our friendly poll moderator here. And let's ask the question. As of September 30th, 2017, what would you guess the percentage of FHLB Des Moines non-credit union membership was using public unit deposits as a portion of their funding base? Was it A, less than 25% of the membership, B, between 25 and 50% of the membership, C, between 50 and 75% of the membership, or D, more than 75% of the membership? So, Scott, over to you. Let's open the polls.
All right, the poll is launched. I'll leave it open for about a minute here.
Okay, one of four choices, please. Scott, are people voting?
Yeah, we're getting quite a few, 87% voted.
Okay, so we'll give it another 5 seconds. All right. Buzzer goes off.
For voting, we have pretty much everybody in.
Okay, what is our correct answer?
So up on the screens, the majority went with, or most votes went for more than 75%.
All right. So we have a very adept membership here. D is indeed the correct answer. We show that 96.7% of bank members of the FHLB Des Moines posted public unit deposits of some kind. Interesting results. It is a significant piece of the membership. We often see different reasons for our members deploying public funds. Sometimes it's done in the name of funding diversification, right? Other times it's an effort to increase exposure to public entities and an effort to court other types of business, such as cash management or simply community visibility, right? Okay, so the last slice and dice that we took a look at was average public unit deposit activity that our members undertook. This was year-end 16. We're going to freshen up numbers here shortly for 17. But in any event, you can see that average PUD balances continue to decline historically to an average of about $80 billion among membership. In fact, we saw that 97% figure. It's impressive usage. So back to the all-important topic we talked about of collateralization. Some of you on the webinar may recall the darker days of about a decade ago when some financial institutions had failed and had outstanding public deposits that were in excess of the $250,000 insurance limit. Tough times. Some public entities were exposed without additional collateral, such as pledged securities or letters of credit that could have been pledged in their favor. So indeed, we had some member financial institutions that were exposed in cases where they were parts of investment pools that were structured jointly and severally. They were at risk. So there were situations in which they were parts of state investment pools, as an example, which had failed, and without the adequate collateral, there were exposed public units, and they were forced to call on perfectly healthy members through no fault of their own, members of the investment pool for these deficiencies. It wasn't fun. So again, getting back to those 2013 FDIC statements, regulations regarding PUD coverage, FDIC exposure to an insured institution is confined, as we know, to $250,000, and that $250,000 applies cumulatively for time savings accounts and DDAs per public unit. And again, in its guidance on collateralization of public units beyond those insurance limits, the FDIC specifies that collateralization provides an avenue of recovery in the unlikely event of a failure of an institution. So again, in the case of securities pledging as a collateralization method, we know that public units are exposed. Procedurally, a mutually acceptable trustee or custodian for securities collateralization. They provide frequent securities collateral reports to the public unit. And these reports entail the accurate reporting of market values, maturity dates, substitutions, a lot of moving pieces here, a lot of key variables, and it does take some time and effort to measure and monitor collateral level adequacy on an ongoing basis. We know this in talking to the municipalities, especially the state investment pools, and we hear a lot about this from our members. So the question now really becomes, are there possible alternatives or complements to public unit deposit collateralization? Again, the traditional method is securities pledging. So these options, they vary and can depend on state and local statutes and investment policies of the public unit depositors themselves. Typical collateralization methods can be FHLB, or for that matter, in some locales, Federal Reserve letters of credit. Even the surety bond people are getting into the game, or most commonly, of course, is pledging of a depository's eligible securities. Although pledged securities as a form of collateralization has historically been the most widely used method, especially in times of excess liquidity, say over the past 10 years, this form of collateralization does bear some detracting features from both the perspective of the public unit and the depository. Securities collateralization encumbers highly liquid assets, your treasuries and agencies, and in turn, they could impact liquidity measurements such as, for instance, pledged securities ratios and liquidity ratios. So from the perspective of a public unit, a depositor, the constant monitoring again of inevitable security substitutions caused by maturities, calls, and sales, it's a detriment. And in any event, in addressing the best practices for public unit investment policies, many of you out there have heard of the GFOA, the Government Finance Officers Association. They're good people to know. They recommend the use of a written agreement with pledging requirements as protection for a state or local government's deposits. And they do have guidelines, specifically what the GFOA encourages PUDs to do is to establish adequate and efficient administrative systems to monitor pledged collateral, including state or locally administered collateral pledging or collateral pools. And they do recommend that public units implement some formal type of depository risk policy, which goes along with credit analysis, and that they use fully secured, high-quality investments. If there is no state program for pooling collateral, the GFOA and other organizations advise them to implement these collateralization procedures, including fairly heavily prescribed procedures to monitor their collateral positions. And when you monitor collateral positions, there's the potential of under-collateralization, which might threaten the safety of an entity's deposits. And we don't want to relive the 08, 09, and 10 experience. So taking inventory of some of the more burdensome aspects of the various options. Pledged securities, we know, can encumber your highly liquid treasuries and agencies. Occasionally, members do use reciprocal deposits as a means of attracting PUD business. Here again are some issues. Historically, the reciprocals have been considered brokered deposits. There may be capacity and settlement limitations that don't coincide with a public unit's cash flow requirements. And importantly, this is kind of interesting. The reciprocal deposits do bear overnight exposure to the public unit because of settlement times. That's something that's often forgotten. As another alternative, I mentioned surety bonds. They can be commissioned by financial institutions for public unit deposit collateralization. Pricing can be all over the map. They can be subject to calls by their underwriters. And again, there are monthly reporting requirements on daily deposit levels. So enter please, stage right, the FHLB Des Moines standby letter of credit. It's often viewed as an acceptable and efficient means of PUD collateralization. Many municipalities recognize the benefits of the AAA, Moody's, and AA plus Standard & Poor's rating, and they see letters of credit as easier to monitor than securities. And the public unit depositors, which again are very safety conscious, recognize that should there be a default, the exercise of the right to security collateral could be cumbersome and could be time-consuming, more so than simply drawing down on a letter of credit. Here in the flow chart, we see a capital to represent the public unit, the bank or credit union, the FHLB member, as well as the FHLB. So again, it's a standby irrevocable letter of credit that we write directly in favor of that public unit. So they're structured, as irrevocable agreements that are written in favor of the public unit, so that in the event that the FHLB depository, the member, fail to perform as defined, typically it would be a principal or interest default, the public unit would then be able to immediately draw on the letter of credit. And the letter of credit is typically written with a 1-year maturity that can be renewed at the discretion of the FHLB Des Moines. Each dollar, importantly, of a member letter of credit counts as exposure that's earmarked against both the credit line and the collateral availability of the member. Still, instead of pledging liquid collateral, the member, in theory, taps into less liquid collateral, such as SFRs, CRE, and other forms of collateral, in order to raise the collateralization that's necessary to procure public funds. So in other words, you're doing this instead of pledging your highly liquid marketable securities. So again, what happens, referring to the flow chart, first an FHLB Des Moines member institution requests a letter of credit, and that's via an application. And then next, an irrevocable standby letter of credit, something that we generate in favor of the public unit. And once that letter of credit is in place, the member financial institution is all set to generate funding from the public unit now that the institution's deposits in excess of the FDIC or NCUA limit of $250,000 is adequately covered. And public units tend to like LOCs as a method of collateralization. Why? Well, just as a member would need to track security coverage, they do too. And the high rating of the FHLB Des Moines allows many states and localities to allow letters of credit for collateral. So let's look at the dark side for a moment. In the event of a member default, a PUD that was collateralized with pledged securities would entail a public unit going through the excruciating process of exercising the right to procure and liquidate security collateral. Instead, using the LOC, a default again would allow an immediate draw against that letter of credit. So the costs associated with issuing an FHLB Des Moines letter of credit, they're minimal in the whole scheme of things from the perspective of a member. There's no cost that's borne, of course, by the public unit depositor. And we talked about the operational efficiency. And you could also build a case that by reducing the amount of pledged securities, that a member may be encouraged to redirect capital from lower yielding investments to higher yielding assets, their mainstays, such as loans. Okay, so currently, when you look at the geographic map, public unit deposit related letter of activity is conducted by the FHLB Des Moines in 11 of our 13 states. And many states have specific public deposit statutes that reference the ability of their public units to accept FHLB Des Moines letters of credit. These statutes, you need to realize, can change. It's also a good idea to take the pulse of statutes in states outside of the Des Moines district. That's in the event that you're looking to raise PUD funding in other states. And as an example, give you an example, as of last October, FHLB Des Moines members can use letters of credit to back demand deposits for the state of California. Curiously, within California district institutions cannot yet issue time deposits or deposits on behalf of other public entities in the state. And perhaps these and other items belong in the government relations radars of our members as well as trade associations. But this is constantly something that we need to keep track of. Well, enough of that. We know you're out there. The vast proportion of attendees on the webinar, we know, use public funds. We know that it's about 97% of the membership. And many of you, excuse me, as a result, require some degree of collateralization. We're curious at this point to see what forms of collateralization that you, the members, use. We're going to present some choices here. It's okay to vote for more than one item. In Chicago, we vote early, vote often, but that's not in the district. So here's the question. What form of collateralization does your institution use to collateralize public unit deposits? Here are the possibilities. And again, feel free to tick off more than one. You can pledge securities. You can have FHLB standby letters of credit issued. You can request surety bonds, other forms, or maybe you don't solicit PUD funding at all. So Scott, why don't you open the polls and let us know what the audience has been up to in terms of the types of PUD collateralization that they use.
All right, the poll has been launched. Keep it open for about a minute here. And again, as John said, you can choose more than one.
Still voting.
Still voting.
Want to give it another 10 seconds?
Yeah.
Okay.
About 85%.
Buzzer will sound in 2 seconds.
All right, we'll close the polling.
What do we have?
90% voted, and 84% said they pledged securities, with FHLB LOCs coming in second with 33%.
Interesting results. So a lot of securities pledging going on, and 1/3 of the audience does use and has got to be familiar with our letters of credit. All right, so let's talk about, for just a minute, the issuance process. It's simple. What you do is you submit completed letter of credit applications. Those are all available on the FHLB website. You could even simply Google FHLB Des Moines Letter of Credit PUD application and get easy access to that. Then what you do is you send that application into the money desk. We can even do same-day processing up to 3 p.m. Central Time. And do remember that dollar for dollar there is an allocation against your credit line and credit or collateral availability. But do realize that unlike taking down advances, there is no stock activity purchase requirement associated with taking down a letter of credit. One additional item to mention here. This might be something to put on your radar. Many municipalities and public units work with outside money managers that assist in running their deposit investment programs. As an example, if you've been on our website, we have an arrangement with 2 managers, PFM and PMA. What these managers do is they run what are called local government investment pools, or LGIPs for short. And these pools or programs allow members to participate and obtain funding. It gives them access to fixed rate, fixed term CDs that are placed by local government investment pools. So what happens is, in turn, these depositories, they need to provide collateral to the LGIP from which the deposits were obtained. And users of these programs obtain that require collateralization by way of an FHLB letter of credit. They're typically associated with requirements such as matching the term of a CD, plus 2 additional days beyond the maturity date. So as an example, a 90-day CD issued under these programs, they could require a 92-day letter of credit, again, 2 days beyond. So, also the stated amount of the letter of credit would need to include both principal and expected accrued interest. Again, we have more information on how to take in funding from these pooled LGIP programs on the website. Just go under the tab Public Unit Deposit Program. There's a lot of information there. So why do members elect to obtain funding from these different types of investment pools? They're convenient, they're cost-effective ways to access a previously untapped source of public unit deposits, and they can serve as a complement to FHLB Des Moines advances. And again, our website has a direct link to these select LGIPs and to various other investment pools, such as the Missouri Security Investment Pool and the Minnesota School District Liquid Asset Fund. If you agree to the prevailing deposit rates and terms that they have, all you do is you simply file a letter of credit application, which would request an LOC to be issued in favor of the pool as the appropriate beneficiary. Okay, so standby letters of credit I mentioned are simple here. We price them uniformly. They're all now at 11.5 basis points per annum, irrespective of size. Fees are payable at issuance with a minimum charge on the letter of credit of $250. Just as we recently collapsed pricing on advances, the same thing applied to what we're doing here with letters of credit. So to illustrate a few of the issues and options that we typically see faced by the members, I'm going to give you 4 cases to just quickly run through. Case 1 would be what we'll call the case of the forgotten security call. Historically, here's a financial institution that has collateralized a public unit deposit with a pledge of callable agency securities. And let's say the member subsequently receives notification but the callable bond will be called in 5 days. That's the next scheduled call date, let's assume. So what are the options? We'll go down one of two paths. Either the member is going to hurriedly pledge an alternative security or occasionally run, we do this on occasion, the risk of forgetting to replace that collateral. And given settlement times and monitoring requirements, that can sometimes be a headache. Or there's path B, and that is to consider collateralizing that deposit until a security, replacement security is found with a letter of credit. Again, I mentioned that we can do so same day up until 3 p.m. Central Time. The letter of credit, it can be customized by any amount or time frame. You could even take a longer-term view and consider replacing part or all of the securities pledging program with a letter of credit program. So I'll give you another example. Case 2, we'll call this the case of diminishing securities availability for collateralization. Here we are in a situation where we have a recovering economy, we think, where you do have members which are sustaining some pretty good loan growth. And as a result, we've seen the LTVs picking up a little bit. We've also seen the securities portfolios decreasing in size in order to fund a portion of that loan growth. And an increasing percentage of securities positions are already pledged to a lot of public unit depositors. I mean, we know that. Again, 97% of you in the audience, in all likelihood, are using public unit deposits. You're pledging securities. So what are the options in this sort of environment? A is you're going to continue to pledge securities. Are you going to run the risk of suppressing further loan growth due to liquidity constraints? Look at these two key barometers, pledged securities ratios, as well as the standard FDIC defined liquidity ratios and what happens to them. Or another option, plan B, is you procure a letter of credit and pledge the growing amount of loans, right? SFR, CREs, and as you know, multiple collateral categories on the less liquid lending side can apply here as collateral, and go ahead and continue to fund that loan growth. It's your main business. Let's look at another case, maybe not so apropos today, but it can happen. Let's look at the case of decreasing securities eligibility. So here we have a member that has historically supported a portfolio with a lot of agency mortgage-backed and callable agency securities. Let's look at a situation where rates drop and that many of these securities, especially the MBSs, pay down quickly or securities have been called. As an alternative investment option, maybe you want to redirect some of your investment portfolios into municipal securities. As we know, municipal securities are typically not accepted by a lot of public units as an allowable form of collateralization. So here again, a couple of options. A, you refrain from purchasing those municipal securities that you want to reallocate into and continue running the risk of further securities pay down in a dropping rate environment. Or alternatively, go ahead and shift to those municipal securities purchases and pursue that revised investment objective by redeploying that securities pledging into a letter of credit program. So finally, here's another case, and we're seeing a lot of members do this one, and we can provide some help as we'll show you here in a second. It's the case of the strategic review of liquidity coverage and income, these so-called issues of capital redeployment from lower yielding securities into higher yielding loans. And it goes like this, that we're all under margin pressure. We're all subject to regulatory discussions. And a financial institution's management team often wants to sit down and review means of how to improve liquidity and income. Those are the two moving pieces. And again, we see and we do note that an increasing portion of public unit deposits, as our own polls have shown here this morning afternoon, as being pledged by securities. So here are the options. You're going to continue to deploy capital towards these lower yielding securities and pressure pledged security and liquidity ratios, or go ahead and examine the positive implications associated with these 11.5 basis point letters of credit. We'll see. All right, so time to fess up here, audience. We mentioned several case studies, 4 of them. The first one involved the administrative burden that is sometimes associated with the reporting and re-reporting of security substitution and adequacy. It's always under the radar. The second case, we talked about growing loans and the prospect of a diminishing amount of securities available to fund that growth due to securities being tied up as pledged to the public unit depositors. We talked about a third case, remember that one, where rates drop, and we were talking about an increasing amount of securities that are encumbered, limiting changes in portfolio reallocation possibilities. And then lastly, case 4, we talked about a case of too much capital being deployed to lower yielding securities instead of those higher yielding loans. So if you faced any of these issues, which are represented by these 4 cases, and it's okay to tick off more than one of these instances, feel free to vote. Again, more than one choice is fine. Scott, over to you with the poll.
All right, I've launched the poll again. Check all that apply to you, and it'll be open for about a minute.
Think about what's happened to your organization. Which of these cases may apply to your institution? How are we doing, Scott?
I don't know, 50% voted. We'll hold it open for another 10 seconds or so.
Sounds like a plan.
All right, we've got about 80% voted here. I'll close the poll.
Okay.
Looks like the results are most have troubles with the first one, substituting collateral with short notice, coming in at about 60%.
Yeah.
And the less securities for loan growth and reallocate investment portfolios are right at 34 and 39%. And the last one, in terms of too many low-yielding securities versus high-yielding securities, coming in the lowest, about 26%.
Interesting. So the polls show that there are some quality of life factors that the members are sensitive to. These are the securities pledging process. And it's interesting, case 4 is something that we'll examine right about now. So we'll consider right now a financial institution. Here's another case study we're going to throw at you. Here's an institution that currently funds itself with, let's say, $55 million in public unit deposits. And we take a look at its call report, and we see that it owns $300 million in marketable securities. So about 20% of its $300 million securities position, or $60 million, is pledged, and assumedly all of its $50 million in uninsured public unit deposits that we're noting here are backed by pledged securities. Let's assume that for right now. So we're going to further assume that this particular member has a 35% credit line against its $1.286 billion in assets, or $450 million in capacity. And we'll further assume that it has available remaining eligible collateral capacity of $150 million. So the member would like to assess the impact of securing a portion of its outstanding public unit deposit activity with an FHLB standby irrevocable letter of credit that again would be written in favor of the public unit in the event that the member financial institution failed to perform. So above the FDIC $250K limit, the members historically pledged high-quality Treasury and agency securities. And in this case, we're going to assume that the weighted average of those securities is generating or carrying a yield of 2%. And that's generating or translating into an annual income of $1.2 million. So the member is going to be looking at another option. The member is going to be looking at the possibility of pledging $25 million of that security requirement in lieu of pledging securities. So if they elected to do that, they're going to consider the impact of the opportunity to redeploy capital to higher yielding assets instead of marketable securities. So these higher yielding assets, they could be anything from mortgages to C&I loans to commercial real estate, the mainstay. So we'll assume that the proxy for an alternative higher yielding asset is going to be, let's say 4.25. So you're redeploying capital into 4.25 versus a 2% yield on marketable securities. So you're going to next compare the existing securities generated income with the income of the higher yielding assets. So that $25 million transfer from pledged securities to letters of credit would encourage the member to generate an additional, in this example, $534,000 in incremental income. And we can run this sort of analysis for any FHLB Des Moines member. Just contact your relationship manager and we can go ahead and run some customized scenarios for your institution. Another key thing to look at here is the balance sheet side of life. That under the current format, you're going to be looking at a liquidity ratio of 30% as FDIC defined. You're going to be improving to 31.23% in this instance. Even more impact if you look at the liquidity ratio starting out at 20 and dropping quite a bit to 11.67. That's really where a lot of this does tend to show up. Although the public unit deposit application represents, as we suggested earlier, by far the highest amount of letters of credit that we issue, there are some other applications for the FHLB letter of credit. And in fact, we're going to be discussing them in a subsequent webinar. We'll let the members know, but this is going to be in the later April, May time frame. As an example, we're seeing quite a bit of activity lately in using FHLB LOCs to confirm bonds and other issuances. The ROE economics from a member's perspective relative to direct lending can be quite interesting in these instances. Also, customers of members can also benefit from applications such as self-insurance programs. Talk to our team and member strategies or your relationship managers about any case studies that you see in those areas. And according to our statutes, as provided by our regulator, the FHFA, the bank can go ahead and issue irrevocable and confirming letters of credit on behalf of members or housing associates for any purpose, such as facilitating residential housing finance, helping out with community lending, helping our members or housing associates with their asset liability management needs, providing members with liquidity or funding. So the nexus of assisting members with liquidity is widely used. So when a member submits an application to us, for a letter of credit, it always is the member's responsibility to ensure that the use of a letter of credit complies with any regulation to which the member itself is subject to. All right, so we are going to do our final poll. Our final poll, what we've done on the webinar right now is just focused on letter of credit applications towards collateralization of public unit deposits specifically. And as I touched on, there can be other purposes that are associated with our letter of credit issuance. We'll have a subsequent webinar, as I mentioned, and other applications that you might have run into could include meeting counterparty requirements, or perhaps unique liquidity, community lending, housing, or other requirements such as customer insurance requirements. Pardon me. What we're going to do in the poll is ask you which of these applications do you think might warrant FDIC or FHLB Des Moines as a possible solution, or perhaps even something that you'd like to know more about. Scott, as you can tell from my scratchy voice, we're in the last stretch of the webinar, so let's see where the levels of interest might be.
All right, poll's been launched. Go ahead and vote. I'll close in about a minute.
All righty.
Hold it open for about another 10 seconds here. All right, we will close the poll. John, it looks like overwhelmingly PUD collateralization and about a quarter for other requirements. PUD collateralization coming in at 70%.
Excellent. Okay, so other applications, talk to your relationship manager and let's further qualify what these other applications are. Talk to us one-on-one. So for now, we hope that we built a decent case for further consideration of standby letters of credit written for the purpose of collateralizing public unit deposits. Excuse me. What we will do now is we'll open the floor to any questions that people might have.
John, we have one question that came in on the question box on here. The question is, we have 3 different public entities that have fluctuating balances that can prove difficult at times to have adequate pledging. Can we use one letter of credit for all 3 entities, or does a separate letter of credit need to be executed to each public entity?
Okay, so we have done in rare instances these sorts of letters of credit on a pooled basis. Talk to your relationship manager about that, but oftentimes we issue letters of credit on behalf of state investment pools. But the largest percentage of our letters of credit are issued on a one-on-one basis. But it is possible. Talk to your relationship manager would be my advice with the specific situation.
Yeah.
Couple of others. Can you please elaborate under what conditions a public unit draw on an FHLB standby letter of credit would be? Yeah. So if you look at the letter of credit documentation, there's a key phrase in there, and it basically mentions that an event of default is defined as a separate agreement that the beneficiary, that's the PUD, and the member has, which constitutes default. So if there's a draw on our LOC, it's conditioned on that defined event of default. And most of the time it's a P&I default typically, but the triggering or the draw against the LOC is based on that separately defined event of default. Hopefully that answers the question. One more. This relates to the statutory permissions of state by state locale by locale. Why is it so inconsistent? It's often political and legislative dynamics. I pointed out that Utah, or you can see in the slide that Utah and Alaska currently do not permit FHLB LOCs to be used as a source of collateralization. And you've got the murky situation in California that I described. So my advice would be work with your trade associations, your ICBA and ABA affiliates, your CUNA and NAFQ affiliates to do whatever, to suggest whatever changes on the legislative side could take place. Another question, can you clarify whether letters of credit would work to replace repos? I'm assuming that question relates to customer repos. There's a degree of difficulty there that we have run into on occasion, and that is FDIC and sometimes NCUA interpretation. And that is that the relationship that we have in the event of a bank failure or a financial institution failure with the deposit insurers is such that they would view LOCs as supplementing or covering or replacing repos is not an encouraged practice. So hope that answers the question.
John?
Okay, one more?
Yes, another one just came in. Can standby letters of credit be used for a group of public deposits simultaneously? So pooling.
Pooling, yes, a good example would be in the case of these LGIPs. Yeah, on a pool basis, yeah, we could put that together. Okay, do we see any more questions on the horizon? Scott is saying no. From sunny and at the same time snowy Seattle, we thank you for tuning into the webinar. And stay tuned for our next one on other LOC applications sometime in April or May. Stay tuned and thanks for joining.